Imagine this. Some of the biggest, most powerful financial institutions on Wall Street, the very same ones who often seem to dictate market movements, are quietly making a very specific, strategic play. They're shorting silver miners, not just silver futures, mind you, but the actual companies that dig silver out of the earth. And they're redoing it with a subtle precision that suggests there's a much deeper game at play here. Now, before you panic and think this is a bearish signal for the entire silver market, let me assure you, the truth is far more nuanced and, frankly, far more exciting. What if I told you that this quiet, almost secretive move by big banks isn't necessarily a sign of weakness for silver, but rather a calculated maneuver that could in fact be setting the stage for one of the greatest opportunities we'll see in the precious metal sector in a generation? This isn't just about banks making money. It's about understanding their strategy, deciphering their actions, and positioning yourself to potentially capitalize on what they might be seeing further down the road. Welcome to a deep dive into the quiet machinations of the silver market, where we'll peel back the layers of institutional strategy, expose the potential motives behind these significant short positions in silver mining stocks, and most importantly, uncover what this truly means for the savvy investor looking to grow their wealth. We're going to explore why these financial giants might be making such a move right now when the fundamentals for silver, both as an industrial metal and a monetary asset, seem stronger than ever. This isn't just a story about market trends. It's a story about power, leverage, and the incredible, often hidden opportunities that emerge when you understand the big players' moves. Let's start by demystifying what shorting actually means, especially when we talk about big banks shorting silver miners. In essence, when you short a stock, you're betting that its price is going to fall. You borrow shares, sell them at the current market price, and then you hope to buy them back later at a lower price, returning the borrowed shares and pocketing the difference. It's a high-risk, high-reward strategy, and when massive financial institutions engage in it, it signals a very strong conviction about a company's, or in this case, an entire sector's near-term prospects. So why would these sophisticated investors with all their resources and market intelligence decide to short silver mining stocks at a time when global demand for silver is projected to remain robust and economic uncertainties are pushing more people towards safe haven assets like precious metals? This is where the plot thickens and where the real opportunity begins to emerge. For decades, the relationship between big banks and the precious metals market, particularly silver, has been a source of intense speculation and controversy. Allegations of market manipulation, suppressing silver prices through massive paper short positions on the COMEX futures market have been prevalent. Critics argue that these institutions have historically used their immense capital and influence to drive down prices, allowing them to accumulate physical silver or establish long positions at artificially low levels, only to profit handsomely when the market eventually corrected. Whether these claims are entirely true or not, the perception of banks as powerful, often manipulative, forces in the silver market is deeply entrenched. So when these same institutions quietly start shorting silver miners, it immediately raises red flags and prompts us to ask, what game are they playing now? One potential reason for these short positions could be a hedging strategy. Big banks are often involved in complex financial transactions, holding vast portfolios of various assets. They might be long on other commodities, currencies, or even some specific silver futures contracts. Shorting silver miners could be a way to offset potential losses in other areas of their portfolio if they anticipate a broader market downturn or a temporary dip in commodity prices. It's a sophisticated form of risk management, ensuring that no matter which way the market swings in the short term, their overall exposure remains balanced. However, the scale and quiet nature of these shorts suggest there might be more to it than just simple hedging. Another angle, perhaps more aligned with the real opportunity narrative, is the idea of tactical shorting for strategic accumulation. Imagine you are a colossal financial entity with a deep understanding of market cycles and an even deeper pocketbook. You believe that silver, due to its unique industrial demand and its role as a monetary metal, is fundamentally undervalued and destined for significantly higher prices in the long run. However, you also know that markets don't move in a straight line. There are always corrections, pullbacks, and periods of consolidation. By strategically shorting silver miners, these banks could potentially accelerate or deepen a short-term correction, driving down the share prices of these companies. This temporary dip then creates an even more attractive entry point for them to establish massive long positions in the underlying physical silver, or indeed, in the very silver mining stocks they previously shorted. It's a classic shakeout maneuver, creating fear and uncertainty to buy assets from panicked retail investors at a discount. If this hypothesis holds true, then these current short positions are not a bearish signal for silver's long-term future, but rather a deliberate strategy to acquire valuable assets before an anticipated major upswing. Let's pivot and look at the incredibly strong fundamental case for silver, which makes these short positions even more puzzling on the surface, and thus more intriguing as a potential opportunity. Silver is often called poor man's gold, but that's a misnomer. Silver is unique because it combines the safe haven properties of a precious metal with critical industrial utility. This dual demand profile makes it an indispensable commodity in the modern world. On the industrial front, silver is absolutely essential. It has the highest electrical conductivity of any metal, the highest thermal conductivity, and the highest optical reflectivity. These properties make it indispensable in countless high-tech applications. Think about the burgeoning green energy revolution. Solar panels are a massive growth area for silver demand. Every solar panel relies heavily on silver paste to convert sunlight into electricity. As nations worldwide commit to renewable energy targets, the demand for solar installations is only going to skyrocket, taking silver demand right along with it. Beyond solar, consider electric vehicles, or EVs. These cars contain significantly more silver than their internal combustion counterparts, primarily in their electrical contacts, battery components, and various electronic systems. As the automotive industry rapidly electrifies, this sector will contribute substantially to overall silver consumption. Then there's 5G technology, countless electronic devices, medical applications, water purification systems, and even advancements in photography and mirrors. The sheer breadth of silver's industrial applications means that as global technology advances and economies modernize, the demand for physical silver is set to grow relentlessly. This isn't speculative, it's fundamental. Now, let's consider silver's role as a monetary metal. In times of economic uncertainty, inflation, and currency devaluation, both gold and silver have historically served as reliable stores of value and hedges against inflation. With central banks globally engaging in unprecedented levels of quantitative easing, printing vast amounts of currency, and national debts spiraling, the purchasing power of fiat money is constantly being eroded. People are increasingly looking for tangible assets to protect their wealth, and physical silver alongside gold stands out as a prime candidate. It cannot be printed into existence. Its supply is finite and requires arduous mining efforts. The current economic outlook, with persistent inflation concerns, geopolitical tensions, and potential for further market volatility, only strengthens the case for silver as a safe haven asset. When inflation heats up, investors typically turn to hard assets. When the stock market gets rocky, precious metals often shine. We're seeing elements of both these scenarios playing out right now, making silver an even more attractive long-term investment. Let's also talk about supply. The supply side of the silver equation is equally compelling. Unlike gold, which is often found in primary gold mines, a significant portion of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. This means that silver supply is often constrained by the economics of these other base metals. If the prices of copper or zinc are low, fewer mines will operate, potentially leading to a reduced silver output. Moreover, finding new high-grade silver deposits is becoming increasingly challenging and expensive. Production costs are rising, grades are declining, and environmental regulations and permitting processes are becoming more stringent, making it harder and slower to bring new silver mines online. This confluence of factors points towards a constrained supply environment for silver, creating a classic supply-demand imbalance that typically leads to higher prices. Adding to this, consider the silver-gold ratio. Historically, this ratio has fluctuated, but over long periods, silver tends to be undervalued relative to gold. When the ratio is high, meaning it takes more ounces of silver to buy 1 ounce of gold, it often signals that silver is historically cheap and has more upside potential to catch up to gold. While this ratio can be volatile, its current levels still suggest that silver remains a compelling value proposition compared to its yellow metal counterpart. So, with all these bullish fundamentals, unprecedented industrial demand, surging monetary demand, and constrained supply, why would big banks be shorting silver miners? This is the crux of the real opportunity we're discussing. It challenges the conventional wisdom and forces us to think beyond surface-level interpretations. The answer likely lies in the unique characteristics of silver mining stocks as an investment vehicle. Silver miners are essentially leveraged plays on the price of silver. What does that mean? It means that a relatively small percentage increase in the price of physical silver can lead to a much larger percentage increase in the profits, and, consequently, the stock price of a silver mining company. This leverage works in both directions. If the price of silver goes down even slightly, the profitability of a miner can diminish significantly, causing their stock price to fall even more sharply. This amplified volatility makes silver miners attractive targets for short sellers who believe a temporary downturn is imminent. Big banks, with their deep analytical capabilities, might be anticipating a short-term economic slowdown or a period of dollar strength, which traditionally puts pressure on commodity prices. During such times, even if the long-term outlook for silver remains stellar, a temporary correction in the physical price of silver could lead to a disproportionately large drop in silver miner valuations. This is where the short-term profit motive comes in. They might be looking to profit from this anticipated dip, regardless of their long-term bullish stance on silver itself. Furthermore, these institutions possess sophisticated algorithms and trading desks that can identify technical weaknesses in stock charts, even for fundamentally strong companies. They might be exploiting temporary overbought conditions, breaking technical support levels, or taking advantage of broader market sentiment shifts that temporarily drag down an entire sector. Now, for them, it's about making money in every market condition. And if they can profit from a short-term decline, they will. But here's the critical takeaway for you, the retail investor. If big banks are shorting silver miners, not because they believe silver is fundamentally worthless, but rather to profit from a short-term dip, or to strategically accumulate at lower prices, then their actions, ironically, could be setting up an incredible buying opportunity for those with a longer-term perspective. Their shorting activity could inadvertently create the very conditions for a major price rebound once their short-term objectives are met, or once the broader market recognizes the overwhelming fundamental strength of silver. So how do we, as individual investors, navigate this complex landscape and seize this real opportunity? First and foremost, resist the urge to panic. Do not interpret institutional shorting as a definitive signal to abandon your long-term conviction in silver. Instead, view it as potential volatility that could lead to more attractive entry points. This is not a recommendation to jump in and short silver miners yourself. For the vast majority of retail investors, short selling is an extremely risky strategy. Losses can be theoretically infinite if the stock price moves against you. Instead, the opportunity lies in using this information to inform your long-term investment strategy in physical silver and high-quality silver mining companies. When considering silver mining stocks, meticulous due diligence is paramount. Look for companies with strong balance sheets, low production costs, proven reserves, and experienced management teams. Companies that can weather temporary downturns in silver prices due to efficient operations and sound financial management are the ones that will thrive when the market inevitably turns upwards. Focus on producers with diversified assets, sustainable practices, and a clear growth strategy. These are the companies that offer leveraged exposure to silver prices without taking on excessive operational risk. Diversification is also key. Don't put all your eggs in one basket. While silver and silver miners present a compelling opportunity, a balanced portfolio always includes a mix of assets, including other precious metals like gold, equities in various sectors, and potentially real estate or other commodities. Another crucial aspect to consider is the difference between physical silver and paper silver. Many proponents of silver advocate for owning physical silver, coins, bars, or reputable allocated accounts to avoid counterparty risk and ensure direct ownership of the asset. While mining stocks offer leverage, holding some physical silver provides the ultimate hedge against systemic risk and inflation, complementing your exposure to the mining companies themselves. The narrative of big banks quietly shorting silver miners isn't just a story about trading strategies. It's a profound statement about the underlying value they perceive in silver. They are playing a sophisticated game, using their market power to influence prices, but their ultimate goal is rarely to completely destroy the value of an asset they believe will be vital in the future. More often, it's about accumulating that asset at the lowest possible price. This situation demands patience, conviction, and a clear understanding of your investment horizon. The global economic landscape is shifting rapidly. Inflationary pressures are real. Central banks are navigating unprecedented challenges, and the world is undergoing a massive energy transition that is inherently silver-intensive. These macro trends are powerful tailwinds for silver that are unlikely to dissipate anytime soon. So, as big banks make their quiet moves in the shadows, creating ripples in the silver mining sector, savvy investors should be watching, learning, and preparing. This could be the window, a period of artificially suppressed prices or increased volatility that allows you to build or add to your positions in physical silver and well-chosen silver mining stocks at valuations that might seem like a steal in a few years' time. The real opportunity isn't just about understanding what the banks are doing, but why they might be doing it, and most importantly, how you can position yourself for the inevitable rebound and long-term appreciation that follows. Don't let the short-term noise distract you from the undeniable long-term fundamentals. The quiet maneuvers of Wall Street can often reveal incredible insights into future market direction. In this case, their actions might just be highlighting a temporary weakness that precedes a powerful surge. Stay informed, stay strategic, and be ready to seize this potentially monumental opportunity in the silver market. If you found this deep dive illuminating and want to stay ahead of these crucial market insights, make sure you hit that like button and subscribe to our channel right now. We're constantly working to bring you the most actionable intelligence and help you navigate the complex world of finance. Don't miss out on future opportunities to grow your wealth. Subscribe, and let us know your thoughts in the comments below. We want to hear what you think about big banks' role in the silver market and where you see silver heading. Your engagement fuels our mission to empower you with knowledge.